Hello and welcome to another Nedbank Private Wealth Investment Report. Now, many of you will have joined us last time for investment updates, property market trends, how emotions influence investment decisions, and much more. And all of that is still available on demand. So if you want to watch it, you could head over to nedbankprivatewealth.com. But don't do that right now, obviously, do that later, because today we've got a really fantastic lineup and you won't want to miss it. So let's have a look at who is going to be joining us today. Firstly, I'll be welcoming back Simon Prescott, Head of Wealth Planning, who will be joined by paraplanner Anna Slater, and we're going to be discussing how to visualise your future self and then successfully plan for post-work living. Then it'll be over to Tom Caddick and Madhushree Agarwal from the Ned Group Investments team to explain what's going on in the markets and how they are managing your money as a result. And look, when the news is full of doom and gloom, is moving from investments into cash a good idea? Executive Head of Wealth Management, David McFadgen, will be joining me to explore that and to identify key areas of investment opportunity that you should be considering. Chiraag Patel will be back, giving us an update on the property market and what he sees as the important trends from the very busy spring season. And then finally, David and Simon will be answering your questions live. So do send them in. Make sure you send in any of those questions throughout the show using the panel on your screen. But let's get on with the show. And I am joined here by Simon and Anna. So hello to you both. Really nice to see you.
Hi.
Now, last time you were here, Simon, I remember you were talking about prehistoric times and horses, from what I recall. But what can we expect this time?
So today we'll have a talk about virtual reality and mountaineering.
Excellent, that sounds good to me. Okay. And welcome, Anna. Thank you so much for joining us. Last time you did join us, but it was via a video with your very impressive cash flow graphs. But it's really nice to have you here in person.
Thank you.
Okay, we're going to start with Simon. So just let's start with the basics. What would you say retirement even is these days? What does it mean?
Yeah, so I guess there's a traditional notion of retirement, which is almost you work, you get to a fixed age, and then suddenly it's a complete cessation of work, and it just ends. It's an abrupt end of work, and it's cliff edge. Certainly what we're seeing with a lot of our clients and high net worth clients is there is no longer this cliff edge moment. It's more perhaps of a phased retirement, and we see a lot of our clients moving into more perhaps non-executive director positions, doing more work in charity and more in philanthropy. But certainly what we are seeing is people aren't viewing it now as this full stop.
Yeah.
It's more of a period of personal growth, aligning with the values that they've had throughout their life. And it's actually just a continuation of life. It's just a little bit different, but certainly a period of continuous growth. And I think maybe even the word of retirement, should we use it anymore? Because it has that old-fashioned of, I finished, I'm done, it's a different life. It's not a different life, it's your life. Maybe we should just change it to post-work living or something different.
I think so. I think people feel younger for longer. Definitely. I think previous generations, they sort of felt like they got old, and as you say, it stopped and you started playing golf and that was it kind of thing. It's just not like that anymore, is it?
No, absolutely.
In a good way.
And if we really go back, perhaps old times, you used to work till you dropped.
Yeah.
So fortunately, it's much better than that these days.
Absolutely. Yeah. Much longer lives to live, thank goodness. Okay, Anna, how does somebody even start to get their head around all of this and start thinking about it? Because I think for a lot of people, it will feel a long way off. I mean, I'm no spring chicken, but for me, I don't think about it that often, and I probably should. So how do people start thinking about it?
Yeah, so there were experiments done with people on their deathbed where they were asked what they regretted in life. And actually, very few people stated regretting things that they did in life. And it was much more focused around regretting things that they didn't do. Okay. So how do we help minimise these regrets? And one way, of course, we know is to plan. But the human brain is inherently bad at planning in the future, 5 years, 10 years. It's incredibly difficult for us to associate with that future person, that future person often feels like a stranger to us. And this does also explain a lot of irrational human behaviours that don't necessarily benefit our future selves as well. So now with the advancement in virtual reality technology, they've also done experiments where people will come in, put a headset on to see themselves aged in the future, to associate with themselves more and interact and maybe even have a conversation with themselves. And from this, they found that these people were able to bond more and have a stronger connection to their future selves.
I find this really interesting. You know, is this something we should be doing? Sure, but certainly it does help that connection to a future self. Now, obviously before we started, I took a photo of you, Gemma, and we've aged it.
Okay.
You've not seen it yet, and of course we're live, so this has the potential for going very well or disastrous. So let's show you that photo of you age now.
Oh my gosh.
Okay.
Yeah, that's just me in the morning. Like, that's
Right.
God, it's weird, isn't it?
So I mean, it's quite brief, and appreciate that we're just showing you now. But I mean, is there any sense of, gosh, that is me in the future? Perhaps I should think more.
Yeah, I think it's quite startling. It's not going to be my new profile pic. I can't
no.
lie. But yeah, it does make you think, doesn't it? And it's like, you know, it's inevitable. You know, death and taxes, the only two things, and growing old and all of that. But yeah, it does make you go, okay, so one day I'm going to be an old lady, and what will that look like, and how will I?
How do I want that old lady to be living, enjoying themselves, and so forth?
Yeah, and also Botox.
Okay. All right.
Or facelift, yeah.
We know that though ahead of retirement, it might encourage people to save more for their retirement after seeing that older version of themselves. If you're in retirement, it might encourage you to spend a bit more, to action some of the aspirations that you had for your retirement whilst you're still in that younger age. But we should note though that this isn't going to be for everyone. For some people, this is an awful experience.
Yeah, do you think, so you think some of your clients might sort of almost react in alarm and not feel great about that?
Yeah, but it's not for everyone. And I mean, there's other ways though to connect with your future self, whether this is writing a letter to future you or by using the cash flow planning software that we'll touch on again later.
Yeah, now you did ask a question then, do some of our clients react in a certain way to this? We don't do this.
You don't? Okay,
clients, we don't take photos as soon as they've walked into the office or strap them into a mask or anything like that. But hey, you never know. Maybe in the future this is something that you should do.
Yeah, it sort of does make you think. So, okay, Simon, so if we're starting to envisage what our future selves look like, what are the next steps in a practical sense? And are people doing retirement right? Yeah,
so I'd like to use an analogy of perhaps mountaineering here. So if you ask the average person what is the purpose, what's the point of climbing a mountain, often they'll answer by saying it's to get to the top. If you ask an experienced mountaineer, they'll answer in a very different way. So they'll say getting to the top is only part of the journey, and it's optional. Actually getting back down safely is the most important bit and mandatory. And in mountaineering, around about 80% of all accidents actually occur on the way down. So that might be through the exhilaration of reaching the summit, you let your guard down a little bit, you know, there might be loose gravel and so forth. So we can apply that analogy to somebody's financial life. So when you're younger, you know, you're in the accumulation, the ascent stage, and you're saving, you're investing, you save some more, you try and build as big a pot as possible. And there are certain paths you need to take to make sure, you know, you're doing that efficiently. But once you've reached that summit, that financial independence, this retirement phase, you then start drawing on your money. And there are very different risks when you start drawing on the money, just like on mountaineering. Very different risks when you're drawing on your money that people aren't really aware of.
Okay, so using your analogy, we're on the descent.
Yep.
So what are those risks?
Yeah, sure. So there's three I want to touch on today. One is inflation risk. The second one is what's called longevity risk. And then the third one is sequence of returns risk. So we'll go through these in turn. Inflation risk. I mean, we're all experiencing inflation at the moment.
Yeah.
Inflation can actually be called the thief that keeps on taking. Okay. So high inflation at the moment, many people have never experienced this before. It's been many decades since we've had it this high, and it's quite tough. But the ravages of inflation, you know, even if we use just an inflation rate of just 3%, if we factor that over maybe a 25-year retirement period, that 3% can actually devalue your money by more than 50%. So you start off with £1,000. If you don't do anything with it, it's only worth £500 in the future.
Oh, wow.
So when we're in the ascent of the accumulation stage and we're earning, inflation's often masked because you might be getting salary and pay rises above inflation or at the level of inflation, so you don't really feel it as much. But once you're in retirement and you've not got a set wage coming in, for example, your money's fully impacted by the ravages of inflation. So the second one is longevity risk, and this is the risk of really, am I going to outlive my money?
Okay.
You live too long, you've run out of money, you've ended up at the later life in financial ruin, disaster scenario. Okay.
Yeah.
And many people really underestimate actually how long we are going to live. Yeah.
Okay.
So if we look at, for example, a couple in their 60s, and around about 70% of people in the UK actually live as a couple in mid-60s, there's a 1 in 4 chance that one of you is actually going to make it to age 100. So if you retire at age 60, that's a 40-year time horizon. It's a long time. Now, those statistics are from the Office of National Statistics, and they do include some of the poorest in society who sadly do die younger. So what we do know is if you have wealth, you're likely to live longer. So there's probably more than a 1 in 4 chance that you may live to age 100. So you've got to plan accordingly.
Yeah.
You've got to make sure that what you're withdrawing is sustainable over that period so you don't end up
Don't run
in
out.
financial ruin. Yeah.
Interesting.
So the third risk I want to just touch on is sequence of returns risk. Now, this is a really unknown risk to many. And it's no secret that if you're investing in the stock markets, they don't go on this nice straight line every single year. Some years the markets will soar, some years they will plummet. And it's that randomness of when will we get these returns that creates a problem for sequence of return risk. So we mentioned before about mountaineering. Let's take Mount Everest. The top 10% of the way down is the most dangerous. It's actually called the death zone to mountaineering. Now, when we're looking at decumulation, if we have a poor sequence of returns in the early years, this can have a severe impact on your retirement experience. So it's a little bit complicated, a little bit technical, but I'd just like to give a quick example of this now. So if we can see on screen, we have a table here. And this is 2 investors. They both start off with £1 million each. They're both going to withdraw £50,000 every single year, inflated up. We've used a relatively low inflation rate of 2% here. Both investors have an average return of 5% over the entire period, and they both have the same, what we call volatility. Okay, so you would expect all of that's the same to have exactly the same retirement experience. But if you note on investor A, in years 1 and 2, they have a negative return of 15% in 1 and 2, and then a 7% return thereafter.
Yeah.
Investor B has a nice sequence of returns at the start, and only in year 11 and 12 do they actually have this 15% fall in each year. Then it grows nicely again at 7%. So same volatility, same average return, but let's now have a look at their retirement journeys. So the next chart, this actually shows the actual retirement journey. So investor A has a significantly different experience and in fact actually runs out of money at year 2021. Investor B has significantly more left. The problem what's occurred here is investor A has had a poor sequence of return right up front. With that loss, coupled with the withdrawal, they've actually locked in those losses. So much so that even though there was great returns for the next 23 years, the portfolio never had a chance to recover. Investor A, great sequence of returns at the start. Even though the falls came later, it didn't really impact their portfolio.
Oh, so would you take less out then if you were investor A?
There are many, many options of how we overcome this. There's a way management, investment management styles, the strategy that can mitigate this. Other ways is could you take less out and so forth. Many different ways. What we would say is you need to understand these risks and work with somebody who can manage these risks.
I think that's really interesting because I think what that gets across to me is there's certain amounts of luck, you know, and things that, like you're saying, you can't control that bit, but you can mitigate it.
Correct, absolutely. And it's only when we look back perhaps from markets where we say, okay, that was a good sequence of returns, but we don't know in the short term whether we're going to go into a soaring market or one that muddles along or plummets a little bit. But certainly what we do know is it's a present it's an alive risk, sorry.
Yeah.
And you need to work with an investment manager who
Yeah.
can manage this for you.
Interesting, thank you. Now, Anna, last time you gave us a great introduction to cash flow planning, and how can that help with everything that Simon's outlined there?
Yeah, so the cash flow planning software aims to help illustrate, to map out and analyse a client's financial future. As you said, you can catch up on the Q2 live webinar
Yes.
that we did, where we've given a demonstration of this, or get in touch with us and we'll be able to run through it in more detail with you. But certainly the cash flow software enables us to input these risks that Simon spoke about, to map out and illustrate a client's any life events that are important to them, when they would like to retire, as well as their income, their expenditure, their assets. Our wealth planning service aims to help a client achieve their financial goals, their aspirations, as well as giving them a clear strategy for their wealth, and finally, to give their investment more of a purpose.
Okay, okay,
I
that's
think everything's complex, isn't it, though, when we, when we're doing stuff like this, life's
Yeah.
complex, isn't it?
Yeah,
And
life's complex, the future is complex,
Yeah.
but we will work with you to help build a specific wealth plan that's tailored to you to help simplify the complex.
so it all becomes very bespoke.
Yeah.
And I do recommend that you watch Anna's video from last time, because it really does show you the benefits of cash flow planning. And there is a link in the player. So after this show, you can click on that, or you can visit Nedbank Private Wealth's YouTube channel to watch it. So just to sum up, Simon, what would you like people to take away from this section of the programme?
Yeah, so I think anybody who is approaching retirement, or indeed who is already in retirement, if you've not thought about these risks before or not been made aware of them, first of all, you should be working with a wealth manager like ourselves who understand these risks. Many wealth management companies focus on the accumulation stage, the ascent stage, and perhaps is not well geared up to deal with the de-accumulation, the descent stage. And with ourselves, what we would say is you really need an integrated wealth planning team along with your asset management team, where we can build the bespoke plan like Anna's talked about. We can use the cash flow planning software to map all your goals, your aspirations. Then the investment management team can really build a portfolio that's suitable exactly for you and manages a lot of these risks.
Yeah.
So, I mean, in summary, what I would say, would you ever climb a mountain without a plan?
No.
You certainly would never aim to climb Mount Everest without a plan and a real detailed plan. But within that as well, you'd need an experienced guide, somebody to be working with you to get you up the mountain safely and down the mountain safely. And we believe it's exactly the same in retirement or decumulation. Have somebody who's specialist in this area like ourselves working with you to ensure that your retirement journey is successful.
Yeah.
And to help you live the life you want to lead.
No, it makes complete sense. Thank you so much. And that sounds like an invitation to all of you, because you can see contact details on the screen right now, or you can find them on the player. So get your questions in as juicy as possible, as difficult as you like, and we'll put them to them later. And Simon and Anna, thank you. It was really fascinating. Thank you both. And Simon will join us at the end of the show for those questions, so please send them in using the box on the screen. Now, coming up a bit later, I'm going to be joined by David McFadden to discuss whether cash is a good option given the current economic climate. But first, to give us that insight into what's happening around the world and how that's influencing the investment team's portfolio management, we're going to hear from Tom Caddick, Chief Investment Officer and Portfolio Strategist, Madhushree Agarwal.
Thanks, Gemma. It was great to be back. We've got a lot to talk about. There's a lot to cover. There's been a huge amount of activity across the markets, even though the markets generally across the globe feel like they've moved sideways to a certain extent. There's been a lot going on that sits underneath. Now, our goal for this session is really to highlight 4 key themes that we think you'll find interesting. And then my colleague, I'm joined today by Madhushree, will talk to us about taking that theme and looking at it in the context of the portfolios themselves and how we might respond or manage through that particular theme. Now, we're going to start with the US debt ceiling. It's picked up a lot of trade press, a lot of broader media, and it builds up a degree of a frenzy. Now, it feels like the circus that comes to town. And to a certain extent, I think we'd all be forgiven for seeing it just as that. It's easy to get very complacent, making the assumption that actually a default of the US on their debts would be almost unimaginable. But that's the sort of media frenzy that was being churned up over the last few months. Now, what does any of this really mean? What the media are looking for, what we as investors are looking for, is that the US will be able to pass through both houses this increase in the debt ceiling to enable their economy to continue to function. Now, the repercussions of them not being able to do that are almost unimaginable, but one has to consider them. But what we did see in the US, and particularly within the Treasury market, so that's their own borrowing costs, which are quite often talked about as almost as a risk-free asset, is a huge spike around the time that a lot of this frenzy was being generated in those borrowing costs. So it's easy to get very, very technical about all of this, but you can see from the chart next to me, this big jump up that we saw when there was a bit of doubt as things got close to the wire of being able to pass through without the economy going into either default or going into some form of lockdown. Now, of course, everything was fine in the end, but that did have a ripple effect globally across financial markets and in particular fixed income markets, where we started to see that knock-on effect, much as we did last year within the UK and the gilt market. So that's been a key feature of the last few months. Now I'm going to hand over to my colleague Madhushree, who's going to talk about that in the context of the portfolio itself. Over to you, Madhushree.
Thanks, Tom. So the idea of the US, the world's biggest economy, defaulting is almost unimaginable, but it did create a lot of noise. These black swan events are difficult to predict, and over the short term, it can cause this huge dispersion in returns. So as investment professionals, we have to look through it and stick to our investment process, which provides us a sturdy framework to navigate uncertain times. You can see, as your time horizon increases, your dispersion of returns also narrows. And that increases the certainty of achieving your investment goals. The fact is that as a multi-asset investor, there are lots of tools available to us within the kit pack to help us navigate the different market conditions. And our portfolios have various layers of diversification. We're diversified across asset classes. So equities, which is a main source of capital wealth creation. Fixed income, which helps to preserve capital and limit volatility. Real assets and alternatives, which helps to protect against inflation, as well as providing reliable income streams. We also have the freedom to invest anywhere in the world, to be global, so we have a greater opportunity set, as well as having exposure to specific styles and strategies where we see value and strong fundamentals. Now, I understand this quilted slide is rather busy, but it is a strong illustration, and really what this captures is a sheer breadth of dispersion of returns across different asset classes over the different years. And what's interesting is that by having really an unsophisticated balanced portfolio, which is a mix of these assets, you can immediately start to see the impact of diversification. You can see it really helps smooth out some of those returns. It stays relatively stable. So ultimately, you don't want to put all your eggs in one basket, and that is the benefit of your portfolio being multi-asset class.
Thanks, Madhushree. Now, the next segment, we wanted to talk about a key theme that's been playing out within the market, and specifically the US, over the past few months. Now, at the last update, we spoke to some of the turmoil that we'd seen within the financial sectors following the failure of Silicon Valley Bank and to a certain extent Credit Suisse within the European markets. Now, what we saw there was something of a flight to safety. And what do we mean there? We just mean that we saw sort of, investors either disinvesting from equities or moving to more secure stocks as a result. Interestingly, when you look at a sector, a market such as the US, you have a predominance of very large, highly capitalized firms. Now, on the back of some of the news that came through over the last few months, has really been around generative AI or artificial intelligence. Now, that's been something that's been around for years now, but in the recent period, we've seen huge leaps forward. Now, most people will have heard of things like ChatGPT. Well, that is just one element that has really made investors and markets very excited about the knock-on effects of building efficiencies within the way in which businesses work going forward and how that might play out into future profitability. So what we've tracked on here is really the drive of some of those particular stocks that have come through. And we're showing on this chart an equally weighted market in the US or the normal S&P that we talk to most of the time. And you can see that actually the rally in the market that we've seen has been driven by some of those really large cap stocks which have done particularly well on the back of the buzz that's been generated around ChatGPT. So the likes of Microsoft, Amazon, Google, etc., Nvidia, which has done so incredibly well, that are seen to benefit from this early flush of activity within generative AI. Now, if we had equally weighted all stocks, you can see that actually the US market hasn't done terribly well since that flight to safety following Silicon Valley Bank. Now, I'm going to hand back over to Madhushree, who's going to bring all of this to life in the context of the portfolios.
Thanks, Tom. So as you know, we hold a number of different equity managers. And on aggregate, our top holdings within them are key beneficiaries of AI. We have Microsoft, which has an exclusive partnership with OpenAI, the mastermind behind ChatGPT. They are actively working on integrating ChatGPT into their search engine Bing, as well as their Office applications. Alphabet has also integrated AI into its search engine Google, and Meta plans to create more AI-driven products, particularly in augmented reality and virtual reality, as they align with its vision for the metaverse. It's important to note that our managers have held some of these companies for a significant period of time. They do not simply buy in based on recent hype, but rather because these companies possess stable cash flows, robust balance sheets, and a degree of margin protection. These are precisely the attributes we've been seeking to increase exposure to within the portfolios. And that bias has helped us generate these top holdings. Ultimately, over the last year, we have quite dramatically tilted the portfolios away from companies that are sensitive to a cyclical slowdown and towards recession-proof areas, ones which are dependable in terms of earnings, of which some have got direct exposure to artificial intelligence. Now I'll hand over back to Tom.
Thanks, Madhushree. Now, it would be remiss if we didn't talk about inflation. It's been a key feature to all of our updates in the last almost a year now. And I think the key thing to talk to here has been just how high and how sticky that inflation has been, particularly when we think back to some of the narrative of a good year ago where people, particularly central banks, economists, were talking to a more transient level of inflation that would be a feature but would pass. Now, it's proven to be a lot tougher to tackle, and we've seen that particularly within developed markets. Now, on the chart behind me, what you can see there is both UK, US and Europe. And you can see that actually core inflation, or certainly certain levels of headline inflation, has started to come down, particularly in the US, where it feels far more under control. It's still elevated, but it's coming back. In the Europe also, as well as the UK. Now, with the UK, we've got a slight variation there because it remains higher than the other developed nations. It's stickier, and it does look as if it's going to be with us for longer. So that is something that central banks are really having to get to grips with. But I'm going to hand back to Madhushree just to bring that to life.
Thanks, Tom. Within the portfolios, we have exposure to distinct real assets that protect against inflation. For example, cash flows of our care homes and student accommodation holdings are supported by very long-term leases and stable rent payments that are linked to inflation. We also hold some infrastructure assets, which includes ports, railways and public utilities, such as electricity distribution. Here, the majority of contracts and pricing agreements for these assets include built-in inflation protection. We also hold some renewables, such as wind and solar farms, and they have benefited from the higher power prices we've been seeing since Russia's invasion of Ukraine. And then we also hold gold, which not only behaves as a safe haven during times of uncertainty, but also serves as a reliable store of value due to its limited supply.
Thanks, Madhushree. Now, our final segment really goes hand in hand with that inflationary factor that we were talking about just now, and that is central bank rates. Now, the reason why they go hand in hand is because central banks are fundamentally working to, typically, a dual purpose. One is to keep a lid on inflation, the other one is to promote employment and drive employment. Now, we're seeing full employment effectively in countries like the UK, in areas much of Europe, as well as the US. So that part is certainly playing out, and you could argue is inflationary in its own right. But really where the concern is on the inflation side. So central banks are having to increase rates to try to keep a lid on inflation. The reason why they're doing that is partly because it's the only tool they've really got to try to do so. But they're doing it because in the future, the expectation is that capitalisation costs, the cost of capital generally, even down to the consumer with the knock-on effect of mortgage rates, will keep a lid on or stifle future demand. Now, a lot has been spoken about things like called the transmission mechanism. Well, it will vary depending on which country you're based in. But here in the UK, the transmission mechanism through to the consumer is more delayed because of the way in which mortgage rates are then driven and people having to roll over to new mortgages. You see a different routine in the US. But fundamentally, central banks are walking a fine line, and that is what central commentators, that's what investors and economists are looking for. They're looking for some signs that central banks have, number one, put a lid on inflation. Number two, having gone too aggressive, too fast, too soon to stifle out any future growth and potentially move economies into a recessionary environment, but at the same time are helping to generate a moderate level of potential future growth. So how is that transmitting through? Well, we're only now starting to see signs of these interest rate rises having an impact. But when you look at things like the economic backdrop, and you can see this on this next chart here, and the way in which corporates are responding, you can already start to see a degree of a slowdown. Now, is this a cause for concern? No, not necessarily. It's important to read through a lot of this noise. Really, the key focus here, and for us, is on what does the future hold with central banks and the way in which they will respond and start to move to a more accommodative environment. So I'm going to hand back to Madhushree to bring this to life and to talk about the portfolios on the whole.
Thanks, Tom. We are well aware that we are entering a period where the economic landscape might be more challenging. And so we have a limited preference for risk assets, such as equities. And within equities, as I mentioned earlier, we are favouring high quality companies with greater earnings stability. On fixed income, we have increased this exposure, more specifically to safe haven government bonds, as it has become more attractive in terms of valuations. It's become cheaper to buy as yields have risen. Real assets continue to remain appealing given its inflation protection qualities, and we've been trimming our exposure to the more cyclical commercial property areas and adding to the more defensive infrastructure assets. Our alternative strategies, such as in song royalties, asset-backed lending, private equity, and energy storage, continue to serve as credible diversifiers within our portfolios. And lastly, on cash, it's now become a useful option within a balanced portfolio, considering the market volatility and increased uncertainty. Of course, as investors, we don't view cash as a long-term investment. But there are times where we use it tactically within the portfolio. And whilst we are putting it to use, it is invested in money market funds to maximise our returns, we're really using cash as dry powder. We're keeping it ready to deploy back into the different asset classes when the right opportunities come knocking. We see it as a short-term measure, a short-term cushion in the portfolios ready to be deployed when favourable prospects present themselves. And with that, I'll hand back over to Jemma.
Thank you so much, Tom and Madhushree. Some really interesting insights there. But what does it all mean for you and me? To help explain this, I've got Executive Head of Wealth Management, David McFadden, with me. Now, we've not had you on our programme before, David, so lovely to see you, and very impressive job title. Could you just explain what you do at Nedbank?
Sure, and it's really great to be here for the first time. Thanks, Gemma. So I have the privilege to lead our client-facing team, so the professionals that look after our clients directly, and we've seen some of those already today, and we'll see some more later. That includes our wealth planning team. That includes our private bankers, our investment specialists, our credit and lending specialists, and I think really what's impressive, although it's kind of you to say, is not so much the job title, but it's the sort of professionalism, the dedication, and in fact the passion of the team for giving that advice to our clients, and that's sort of what I'm proud of. So I suppose one way of saying what I do at Nedbank Private Wealth is creating an environment for those professionals to really bring the best of Nedbank Private Wealth to our clients.
Okay, so that said, thinking back to what Tom and Madhushree were saying, should we be concerned?
So I don't think I can just say no, you shouldn't be concerned, because those are real life events, the things that are happening in the real world, and they are impacting people, families all over the world. Inflation, high interest rates, you know, the rise of artificial intelligence, and even, you know, although it has slightly passed for now, the US debt ceiling. So I wouldn't say no, don't be concerned, but from an investment professional perspective and as wealth managers, I don't think we should be concerned, because I actually think it's more the opposite. It creates an opportunity. I think there's probably a couple of things to focus on there. The first is, as professional investors, we focus on the things that we can control, not the things that we can't control.
Yeah.
So if central banks can't even control interest rates, which they're struggling to do, and inflation, then we certainly can't. So what we focus on is how we can then react to those events, anticipate those events, and actually make changes. And Madhushree talked about the changes in our portfolios that react to those events. So I think that's the first thing. I think the second thing is just not to get caught up in the sort of short-term noise, really. Had Tom and Madhushree been talking to us a year ago, they probably would have listed 4 different things that were sort of top of mind. And I'm sure in 6 months' time, it would be another 4 different things that are top of mind. I mean, just as an example, someone was chatting to me this week and reminded me that it's a year ago this week that Boris Johnson resigned as Prime Minister. So if you go back a year from today, you know, a year from a year ago to today, we've had, since then, 4 Home Secretaries, 3 Prime Ministers, 2 monarchs, and that's just in the UK, you know, which is not, it's a small part of the global investment universe. So if you were trying to react to all those kind of short-term events, you know, you take your eye off the ball and really wouldn't sort of focus on what we should be focusing on, which is sort of the end goals and the plans for our clients. So no, we shouldn't be concerned from an investment perspective, but I understand why these things make the headlines, because they have real-world impact.
Yeah, there has been a lot going on.
Yep.
Now, with inflation so high, what is it, around 10% still, or has it come down a bit to 8%?
A little bit,
I lose track a bit, but interest rates are increasing, of course, which affects mortgages, but also savings. So is cash now the best place to be?
So I think the short answer to that is no.
Okay.
But I'll probably expand on that. Cash does have a place, and it certainly has a place in investment portfolios. Madhushree mentioned we're keeping our powder dry, so it gives us the opportunity to quickly anticipate and actually deploy capital when we see opportunity. But it's certainly not the best place to be long term, and you know, I can talk about quite a few reasons for that. I suppose the first is just coming back to inflation. And actually, I'll probably tie that into something that Simon talked about, which was sequencing risk. So, and I'll come back to that, because I know he said it's not a well-known risk, so just to remind people. But inflation, firstly, and I think people do know this, it erodes the value of your money in real terms. Simon used the example, even if it's only 3% over 25 years, that halves your money. But even just, at 10%, which we're not quite at 10% now, but at 10% inflation, your £100 today is worth £90 in a year's time. I mean, it's a pretty stark reality. So the thief of money, I think Simon called it. If you combine that with the sequencing risk, which is that if you have a bad couple of years almost at the start of your investing time period, it really sets you off on the wrong track, and it's really hard to recover from. And Simon showed those two examples. Sure. By being in cash, you're locking in that kind of real loss, guaranteed, right from the start. So I would definitely say that that's a key reason that cash is not a good long-term place to be. The second reason is what I call replacement risk. And I suppose what that means is you might get a good rate today for your cash or for a fixed term deposit, but when it comes time to reinvest that, the fixed term deposit comes to an end in a year's time or 6 months' time, what's the rate then? How do you replace that investment? So, and that's definitely a risk. And in the meantime, we've got inflation. So the things that you might want to invest in, there's a good chance they'll have gone up in value. So another reason why I don't think cash is a good long-term investment. On the other side of sort of almost those are kind of pull factors, what pull you away from cash, what's pushing us into other asset classes. So just a couple of examples. So equities at the moment, and Madhushree and Tom talked about there are different types of equities and different, and we do adjust in our portfolio where we might invest. But across the board, pretty much, maybe with the exception of some growth stocks, equities are pretty good value at the moment. We call it fair value. Okay. So when we analyse the market, so we think that the price that we have to pay for equities at the moment is pretty fair, and in some cases pretty cheap. So actually, it's a good time to buy if you're not invested, and certainly not a good time to sell if you are invested. Why would you sell something when they're fair value or cheap? And then finally, we do have in our portfolio alternative investments, and again, I think Madhushree did reference some of those. Good example would be wind farms. So that's an alternative investment, and those wind farms sell electricity to customers, and within those contracts that they sell the electricity to customers, there are inflation clauses built in. So every year, the price that they get for that goes up by inflation. So again, for those in the UK, it's a bit like the rail fares in January. They go up by inflation plus, and that's built into the contract. So again, there are opportunities created by this lot going on, as you mentioned, that as professional investors allows us to take advantage of. So I would say, clients should talk to their private banker. Everyone's circumstances is different, so I can't say categorically don't be in cash. It might be right for one or two individuals, but generally across the board as investors, it's not the place for us to be. Okay,
so it's really interesting. So Nedbank Private Wealth, you're looking at all those opportunities. No matter what the climate looks like, you can spot them, which is so interesting. And Simon and Anna mentioned earlier about planning to 100 years old because so many of us are living longer. Does the fact that the population are living longer open up any opportunities for investment?
Well, absolutely. 100 years, I mean, I haven't had the photograph done that you have. I'm too scared. I'm too scared. And it does seem a long way off. But absolutely. So, with people living longer, as an example, something we already invest in is care homes. So as we live longer, the reality is that there'll be a requirement for more care homes, and it's something that we've been invested in for several years. But there's also other forms of sort of assisted living. It doesn't have to be a care home. So there's opportunities there. And also, a field I personally find pretty interesting is sort of biotech, we call it. So almost ways that technology can help us enhance our bodies, or at least and minds, or at least stop or halt the decline. So a very simple example of that is a hearing aid. Okay. It's biotech or glasses. But there are much more sophisticated things coming along, and I'm old enough to remember the Bionic Man and $6 million. So that stuff that we were kind of promised in the comic books when we were children,
is on the way.
Is on the way. So absolutely, those are opportunities, and so that sort of demographic change, really living longer as part of demographic change. That's one of sort of four key themes that we're actually investing in some of our portfolios today because, again, change does create that opportunity.
Okay, so you say there are 4 key areas and demographic change is just one of them.
Yeah.
So could you talk us through the other 3?
I can, and I think we have a slide to show people. So, I mean, even within demographic change, I've talked about aging population, but middle class expansion is part of that as well. Again, a classic example might be, which was in the press, you know, a few years ago. Suddenly, a lot of Chinese people were buying luxury goods. Louis Vuitton handbags was the classic example, but lots of other examples. Middle class expansion, not necessarily in the developed world, but in the developing world.
Social mobility in developing countries. Sure.
Exactly. So that's an example. I'll leave the environmental change one for a second. I'll come back to that. Habitual change is an interesting one, and online life as an example. So I don't know about you, but during COVID, I spent more time than I would normally have sort of just listening to music on streaming services, Spotify, that kind of thing, Apple Music.
Shouting out the window, stuff like that.
Exactly. And, you know, I have teenage children. They certainly spend a lot of their life online.
So true. Our habits change, don't they?
Well, exactly. And one way we're taking advantage of that is in investing in songwriting royalties. So songwriters get paid when we listen to something on Apple Music. I think they would probably say that they don't get paid enough. But that's a different argument. But they do get paid, and we can take advantage of that by investing in that. And that's just one habitual change. Nutritional shift, which is on our slide as well. So it's not just going to be sort of Matt Hancock in the jungle. I'm a celebrity, get me out of here. That's going to be eating insects in future, perhaps. You know, there's a sort of movement in nutrition as well. Technological change, we talked earlier, or Tom and Madhushree talked earlier about artificial intelligence.
Yeah.
It's all over the news at the moment, ChatGPT, etc. Absolutely, that's going to change. I almost can't envision, you know, and the thing is that's almost the point. We don't have to necessarily envisage what things will be like in 15, 20, 50 years' time. We just have to know it's happening and be partnering with these sort of excellent fund managers that we use and their private wealth to take advantage of that. I left environmental change at the end because I literally read a stat on this just this week, which is that if the governments and the sort of supranational agencies that are looking to change the way perhaps we use energy, net zero, decarbonisation, all that kind of stuff, are to meet their goals, the level of investment that is going to be required is essentially the same as was required to effect the Industrial Revolution, which was like so imagine like, you know, pre-electricity.
But adjusted for inflation.
Exactly. So massive amount of investment, and we're already, of course, seeing some of that already. So tapping into that, it would be, you know, madness really not to see that as an opportunity and something we can invest in. So change does create opportunity. I think it is easy when you read the newspapers to sort of see headlines of negativity. But actually, you know, there are a lot of positives out there. And Ned Private Wealth, we're really trying to take advantage of that on behalf of our clients.
Fantastic. That's so interesting. And actually, that all sounds really positive as well. So thank you very much, David. And it is nice to have some balance against all that sort of negative noise that we get bombarded with every day. Now, I'm sure there are loads of questions flooding in from you. Keep them coming in. And David will be here at the end of the show for our live Q&A session, and we'll get Simon back in for that as well. So keep them coming in, and the trickier the better. Let's put them on the spot. Right now, though, I am joined by senior lending specialist Chiraag Patel, who is going to give us some insight into the property and lending market, which, as we're all aware, is going through some pretty interesting times at the moment. Hello, Chiraag, and welcome back. Good to see you.
Hi, Gemma. Thanks for having me.
Absolute pleasure. Right, let's start with a little bit of a look back over the years so far. How has the property market been over the spring period, and has it differed from other years?
Yeah, historically, the spring market is when we see more properties come on the market, when we see more transactions. mortgage lenders are busier.
Yeah.
This year's been a bit of a change. It's reported in the market that there's been 1.4 billion of repayments on existing mortgages over and above new lending. The number of mortgage applications seen across the board is lower than kind of pre-pandemic levels. And when I say mortgage applications, that's mortgage approvals, not physical drawdowns. So yeah, it's been very different. I think a lot of individuals have been put off due to the market sentiment, the high inflation rates, the higher mortgage interest rates, all leading on to higher Bank of England base rates. We've seen 13 consecutive increases. The 0.5% increase last week, taking it to 5%. That's all had a knock-on effect over the months. Following Liz Truss's mini budget, things were looking good in April when we last spoke, but inflation has just not come down at the levels expected.
So not quite the normal kind of spring bounce that you're used to seeing.
No.
So what do you think is going to happen over the next 6 to 12 months? Do you think there's going to be more sort of uncertainty and turmoil in the market?
Yeah, I think this will come down to how quickly inflation reduces. I think the market is already factoring in another 0.75% increase as a minimum. But there's also market commentary that Bank of England base rates will go up to and peak at close to 6%, if not higher, at a maximum of 6.25%. That's different to, when we last spoke in April. We were talking about hopefully decreases come the end of the year. I can't see that. I'm seeing increases up until the end of the year, possibly into early next year. But it really comes down to how quickly inflation decreases. And then you've got core inflation on the flip side as well, which continues to increase. And that's, takes out things like energy, food, alcohol and tobacco. That's going up, which is proving more stubborn to control. So I think we'll see a few more base rate increases, and the telling sign will be how quickly inflation reduces.
Well, that's right. And by all accounts, it's going to take a while. I know there's like about 100,000 people every month, isn't it, coming off their fixed rates. So it will take a while. But, interest rates are going to dominate the headlines, I think, for a bit longer. It sounds like it from what you're saying.
Yeah, absolutely. Definitely up until the end of the year. Interesting comment you made about fixed rates. I think, that's one of the reasons we're not seeing the dip in the inflation as expected. There's out of the 9 million odd mortgage borrowers out there, only a third are seeing the hit of the higher interest rates. Figures show that there's up to 2/3 that are still in fixed rates. 800,000 odd individuals coming off by the end of this year, so over the next 6 months. Another 1.6 million coming off their fixed rates next year. But there'll be a time lag between when they see a hit to their bottom line income and household, expenditure, and when that actually hits the economy. So I think it's going to be an interesting 6 months, to say the least. But there's other factors to take into account as well. If you look at employment levels, unemployment's still at record lows. Wage increases is still at not record highs, but still going up. So, the everyday individual has still got the funds there to meet their outgoings. So they might be seeing a big squeeze. They've still got money available to spend.
What about the buy-to-let market? Has that been affected?
I think the buy-to-let market is a really interesting topic. If you look back over a number of years, especially during 2008 to 2022, for example, we saw an upsurge in individuals buying properties to let out. Interest rates were at record lows. They might have been paying 1.5% and the yield might have been really good. But as interest rates have started going up, those individuals that were paying those low rates are now seeing interest rates close to 6%. Rental yields as a result have come down. So that on top of the eroding tax advantages of having an investment property, as well as upcoming regulatory changes for landlords, I think we might see a uptick on landlords exiting the rental market, so selling off some of their stock because they're just not making money or they just don't see it worthwhile. That would also have a knock-on effect on renters. If there's less rental properties out there, what are the younger generation or individuals that have always been renting these properties going to do? Especially if they don't have a deposit and can't afford to buy a property.
Renters do not seem to ever be coming out of these situations very well, do they?
No.
And speaking of which, let's talk about first-time buyers as well. What's the situation there?
I think the number of first-time buyers in the market has dropped off. Okay, but one thing we should never forget is there's always the cash buyers out there. There's always the international buyers that are looking to purchase additional properties for their portfolio, especially the wealthier international buyers. And there's also those individuals that can turn to the bank of mum and dad. Right. So the first-time buyer market will still be there. But I think the age demographic of that first-time buyer population will be a lot higher. And a lot of it will be, please, mum and dad, can you help me? Other than that, I can't really see it being, a booming market for the next, definitely for the next, say, 12 to 18 months.
So complex and interesting times for the UK economy. Is it all doom and gloom?
I don't think it is all doom and gloom. Okay, I think there's a lot of positives out there as well.
Okay.
We are seeing a bit of a later bounce in the spring market. It is getting busier out there. There are more properties coming onto the market, though not, compared to historic levels or average levels. But there are more properties coming up. It's taking up to 63 days for average sales to go through, which is still good. If you look at London, property prices in June, according to Rightmove, went up by 2.8%. Which is positive for London. Some areas are seeing bigger decreases in property prices or values than other areas. It'll be interesting, to see what happens over the next 2 years. Knight Frank think, property prices will, on average, go down by 10%. But that's still low in comparison to what happened post the financial crisis in 2008, between late 2007 to mid 2009. Property prices dropped by an average of 17.5%. So though they might come down slowly, it's still not as bad as it was post 2008's financial crisis.
Excellent. Well, thank you so much for that insight and that overview. Thank you very much, Chiraag.
No problem.
Okay, right, what we're going to do now, we're going to get Simon and David in as Chiraag goes off, and I'm going to hand the reins over to you, our viewers. So thank you very much if you've already sent in your questions, but there is still time to send one in if you're just thinking of one now. Keep them coming in, and you can send them via the panel on your screen. Okay, they've made it back in the hot seats. Welcome back to David and Simon. Now, we're going to start with you, Simon. So I've got a question here. I'm going to put my glasses on. I've got various investments in ISAs and pensions. Which should I take money out of first for my retirement? And is there a specific order that I should be thinking of?
Okay. So first of all, it's good to see that some tax structures have already been put in place, then probably in this ascent stage we talked about before. And I think this is one of the beauties of working with a company that has a wealth planning arm like ourselves, because you should perhaps draw from certain assets in certain orders. And at a very high level here, you perhaps should be drawing from your least tax efficient investments first. And the reason for that being, if you've got ISAs, for example, which are completely tax free, if you leave them to grow, they will grow without an annual tax being deducted from it. So you're going to get a higher level of growth from these because there is no tax drag. Now, if you're leaving those to grow for the long term, this helps with things like longevity risk that we talked about before. So what a planner will do, like me and my team, is we will look at basically your wealth plan. First of all, what do you need? then we can work out which is the best asset to take from, taking into consideration things like income tax in the UK, capital gains tax, and also balancing it perhaps against things like inheritance tax. Because we need to work out what you need now and how we make that efficient, but also if you end up with money at the end of life, how can we pass that down to the children in the most tax efficient way? So at a very high level, draw from perhaps the least tax efficient first, leaving the most tax efficient to grow. But what's sounding there is a plan would be perfect for this client, so they can really see actually how we can have that successful retirement for the individual there.
So it's a good question with an answer that can be worked out.
Yeah.
Okay, David, if interest rates for savings continue to go up, is there a point where you actually think cash savings would be a viable alternative?
Well, I think if we confine ourselves to the realms of the possible, right, rather than let's say theoretical. You know, if it's 1,000%, you might think, well, interesting. But actually, the focus is what is the real rate of interest you're getting, and what I mean by that is the interest rate adjusted for inflation. Now, without going over old ground, even if your interest rate was 20%, but if inflation was 25%, you're actually sort of getting a negative 5% return on your real assets. And over any reasonable period of time, that kind of relationship will hold. The reason we have higher interest rates at the moment, as we discussed, is central banks are trying to combat inflation. So, they're not always in lockstep, but generally speaking, over any reasonable period of time, if savings rates were higher and higher, it's likely that inflation is higher and higher as well. So the same argument really holds. It's the real return that you're getting on your cash that is relevant. So that's why our portfolios actually have target returns of cash plus. That's really how we frame it, because you're always going to get other asset classes deriving their returns, without getting too technical, off the sort of cash, the risk-free rate, as we call it. So it's almost like moving the goalposts, but the goalposts still stay the same size, if that's a good analogy. And I think that's a long-winded way of saying, no, I don't think it would ever be the sensible place to be.
Okay, that makes sense. Thank you. Okay, this is for David as well. What percentage of my savings do you think would actually be okay to keep in cash?
Well, actually, I know you said it's for me. I might ask Simon to comment on an individual level, because really it depends on an individual. There used to be a bit of a rule of thumb from that people should always keep sort of 3 months' salary or 3 months outgoings as a sort of cash buffer. Maybe you'll talk about, Simon, whether that's still the case. I'd probably answer it from an investment perspective, as in what percentage of a sort of diversified investment portfolio might be in cash, because that's really what we're doing for clients from an investment perspective. And we do have cash, and we talked about it earlier, but it's not really an investment asset. We have it there as dry powder. So I think long term, anything much more than sort of 5% is probably showing a lack of ideas.
Got it.
But in terms of what an individual might want to
again, it's almost bespoke to the individual, because from a planning perspective, I mean, you mentioned 3 months worth of cash there. That might be right in the ascent stage. But when you're in decumulation, the descent stage, we talked about sequencing risk, for example, and the first 2 years in that example we gave were quite devastating. So maybe you could keep 2 years worth of cash to one side to fund your expenditure.
Right.
Okay, so that would prevent, or start to mitigate some of that sequence risk issue. But look, so that may be one option for keeping cash. You definitely, if you've got any known capital expenditure, perhaps in the first 3 to 5 years, keep that as cash, because we know markets can be volatile over the short period. But you could potentially say, well, a couple of years expenditure, known capital expenditure, keep as cash. Anything else? If it's for your retirement, look, let's get that working for you over this 25, 30, 40-year retirement. Because as David said, if you don't need it in the short term, leaving it in cash is likely to make you poorer.
Okay. Yeah. Okay, great. Okay, so our next one is for Simon. And this person is saying, I've been thinking about retirement. Do you think it's a good time to retire now?
Wow.
Right this second.
Okay. Gosh.
Not you, Simon.
No. few ways, I guess you could answer that. I think first of all is, look, are you enjoying working? You know, if you're thoroughly enjoying going to work and that's giving you purpose and fulfillment, then should you retire? Well, I would say no. I guess the second way is saying, well, look, I am thinking of retiring, I have some money, but I don't know whether I have enough. Well, again, a wealth planner can work with you to work on a plan and see whether you do have enough to retire. And that might be the trigger for whether it's the right time. And I guess the third way probably links to the sequencing risk. They might be saying, is it the right time to retire because of the markets? Yeah. And that's an unknown because, as we said, with the randomness that the markets generate the returns, we just simply don't know in the next 6 or 12 months whether they're going to soar or be perfect or less than perfect. But I think certainly what we can do with the way we plan for clients and the way we investment manage, we can manage even if we're going to get a less than perfect market. So with that in mind, we can actually remove the question on saying, are the markets going to determine whether I'm going to retire? Yeah. Forget that. We can manage it. Yeah. Okay. Is it retirement right for you? And that's the truly important question that I think.
So it can be purely an emotional decision, like you're ready and.
Yeah, absolutely. I mean, if you're going to work each day and you hate it, let's change things.
Just want to play a bit of tennis, go for it. Okay, we've got one for David. Is it inevitable that commodities will come back into favour? The commodities market seems, rightly or wrongly, obsessed with the Chinese economy's performance.
Wow, that sort of takes me back to my economic theory days, because I suppose one definition of a commodity is something that actually has no intrinsic value. That's right, it's a commodity. So the commodity market is driven by things like demand, global demand, and you can see then why there's a connection to the Chinese economy. Is it inevitable? Yes, I suppose it will come back into fashion in some form or another, and I think it's the Chinese the Chinese economy is definitely a big driver of the global economy in terms of number of people and also just where it is in the economic cycle, still a developing market, etc. Sure. And we talked about middle class expansion earlier as well. So I actually think it is inevitable. Maybe that's too strong a word. I think it's highly likely, but what I would say is, and again, it's the approach that we take, is we're never putting all our eggs in the commodity basket. We are invested in gold at the moment, but we're trying to build a portfolio almost for all seasons and to anticipate events as they happen. So, putting all your eggs in the commodity basket wouldn't be what I would advise.
Okay, thank you for that. And another one for yourself, David. Currently, investment returns across most portfolios are below inflation. Will the returns in the future exceed inflation and make back the lost value? I know you're not psychic, but
no,
have a go.
Exactly. I was looking for my crystal ball. So, now investment returns across most. Could you just?
Yeah, investment returns across most portfolios are below inflation. Will the returns in the future exceed it? I mean, i.e., I suppose, do you have hope that things are going to be
Yeah, I mean,
cyclical?
I suppose I may challenge the assertion because, but over what period is the obvious question. So over sort of a reasonable time period, I would say that actually most investment portfolios, certainly our investment portfolios, are actually ahead of inflation because inflation actually in recent times has only been high, in the last year or so. And of course, if your investment portfolio is a holding in a single stock of Nvidia, which Tom talked about earlier, I think your returns would be vastly ahead of inflation. So, as I said earlier, we build our portfolios to outperform cash, and depending on the risk of the portfolio, that might be cash plus 2%, cash plus 4%, whatever it happens to be. We don't build them to outperform inflation, and specifically that's because you can't actually invest in inflation, but you can invest in cash. And we actually talked about why perhaps we wouldn't, but you can. Absolutely, I do expect that portfolios in general should outperform inflation. Inflation has not been as transitory as perhaps we all expected even a year ago, including the central banks. But there are signs that it's coming down. Certainly the UK in particular has been a bit recalcitrant in that, and it's still sort of ticking higher for lots of reasons that we probably don't have time to go into. But ultimately, yes, we're investing because we do believe that we're adding actually real value, and that's that word real again. You know, it's real returns that we're generating in the portfolios, and absolutely we expect that to be recovered.
Okay, fantastic. And a last question is for Simon. This person says, I am retired and I'm in my late 60s. Is it too late for me to look at a cash flow plan?
No, absolutely not. I mean, it depends again on the objectives. We make it quite binary just for today in saying what do you need in your life, you know? So how can we make the rest of your life effective? You know, how can we make your assets there efficient for you and efficiently drawing down? But also we touched in the last webinar about dying with too much money, you know, so could we encourage people to spend more?
Yeah.
But ultimately, if one of their objectives is to pass money down to children, grandchildren, or even give to charity or philanthropy, then a cash flow will help work out whether, you know, they have the ability to do that.
Yeah.
And again, it's really about purpose. So you have some money. What is the purpose of you and this money? And that's irrelevant, really, of what age you are. It's about trying to work that purpose and then making sure your investments and your money meet that purpose. So it's never too old.
Never too late.
No.
That's brilliant. Look, thank you so much, both of you. Really informative, really interesting. And I'm afraid that's all we've got time for. So we have covered a lot in the hour. Simon and Anna showed me what I could look like when I'm 80. It was wonderful. And also, you mentioned why we all need a Sherpa to take us up the mountain and back down again. And Tom and Madhushree gave us a really great overview of the market and how Ned Group Investments is managing your money. And then David took us through some interesting investment opportunities and talked about why playing the long game is key, before Chiraag updated us on the current property markets. So I want to thank all of our guests today, and I want to thank you for joining us, and we really look forward to seeing you again next time.